Welcome back to the second part of our discussion on how to use present value, future value concepts to make investment decisions. So, in this part, we are going to learn about the different investment criteria, how to use different investment criteria using the present value concepts. So, essentially, there are four important things over here: payback rule, net present value rule, internal rate of return, IRR rule, and the profitability index. 2, 3, and 4 are all related. They are related very closely. And the relation, actually, the foundation is 8.2, net present value. This is the most important thing. So just before we proceed, just to have an idea of what we are talking about. When we are talking of the payback method, this is a very quick method actually, and rule of thumb kind of a method that people had been using in the past and people still use even now, but it doesn't give you the exact it doesn't give you the correct answer always, but people still use it because it's simple to use. So what do we find out here? We find out how long does it take us to recover the initial investment of the project. So if I invest $10 in the project just now, in how many years can I recover this money? Or how many time periods can I recover this money? This is the payback method. The quicker, the better, right? But typically what happens is in this payback criteria, it specifies that a project should be accepted if a payback period is less than a specified cutoff period. So for every different kind of project, depending upon the risk of the project, what industry you are dealing with, and those kinds of things, the nature of the project, there is always an arbitrarily set of cutoff time period. So, okay, for this kind of money, if you invest in real estate, you should be able to recover it in so many years. You might have heard this, and people, they strongly believe in it. And if you invest in, an IT project, okay, you should be able to recover it in so many time periods, so many years. So it depends upon the risk of the project, And the problem with this is it ignores the time value of money concept. It ignores the cash flows that are received after your cutoff period. So it doesn't give you a very, fully realistic picture. And we'll see how this is applied. So here is the scenario here. So there is a cash flow, let us say your projects F, G, and H, 3 different projects. Okay. The cash flow is, $2,000 you're investing now. And then every year in project F, you're getting $1,000 in year 1, $1,000 in year 2, and $10,000 in year 3. For project G, you're investing $2,000 again just now, but you receive $1,000 year 1, $1,000 year 2. And project H, you recover, you again invest $2,000 now, but you recover your $2,000 at the end of year 2. No cash flows in year 3 and year 1. So notice over here that how long does it take you to recover your $2,000? You can close your eyes and you can say that, look, it's 1,000 plus 1,000, 2,000. So 2 years it is taking me for project F. So my payback period is 2 years. For G, project G, again, it is taking me 2 years to recover my 2,000. So my payback period is 2 years. And for project H, again, it takes me 2 years to recover my 2,000. So my payback period is 2 years. You understand? Now the question is, if this is a scenario which is right, they all give the same answers. 2 years, 2 years, 2 years. And when we go to the net present value technique, you will see that, again, simple concept, $1 today is worth more than $1 tomorrow. So you will find here that if you are receiving, first of all, the payback period just looks at the number of years it takes you to collect your money back. So you're just looking at years 1 and 2. That's it. In all the 3 options. You're not even looking at the 3rd year cash flow for Project F. But if you see in terms of today's dollars, if you convert this cash flow to today's dollars and you compare it with the initial investment, if you convert, $2,000 to today's dollars, $2,000 in year 2 to today's dollars, you will see that the net of these two, the present value of the cash received and the present value of the cash paid, the net of these two is negative $347. That is the net present value at 10%, if you're taking 10% average interest rate. The net value of the present value of cash flows, future cash flows, net of today's investment is negative 264 for Project G. But for Project F, you are including year 3 cash flows also in the analysis. So when you discount all these 3 years of cash flows to today's dollars and in net and subtract today's investment, you are ahead by $7,249. So Project F definitely is a more viable option than G or H. But your payback period is just giving you the same answer all the time. So you have to be cautious when you're using this technique. I mean, it might work between your G and H. Even in G and H, this $1,000 in G that you're receiving today is worth more than the $1,000 you receive tomorrow. It'll be worth more. And here you are in the H, you're receiving $2,000 year 2. This is obviously you get negative 347. So again, G is better than H because you receive more money earlier in G. So keep that in mind. Payback method may be easy to calculate your payback period, but it always pays to use a discounted payback. And the discounted payback calculates the net present value and tells you how long does it take you to, get a 0 net present value. You can find out from that by discounting the payback every year. That is the payback method. But the most important technique here is the net present value technique. The net present value technique, what it does is it calculates the present value of cash flows and deducts the initial investment from that and tells you how much present value is left net of the initial investment. The higher this present value, the better it is. The rule of the thumb is at least have more than 0, a positive net present value. Negative net present value will be a failure all the time. You will be losing money. So the rule of the thumb over here is always you have to stay positive, make a wise investment. The net present value has to be positive. Present value cash flows, net of initial investment. Got it? Now here, remember when we are discounting the cash flows, what is the right discount rate to use? What is the right interest rate to use? The right thing to use always is the opportunity cost of capital. The opportunity cost of capital for that kind of a project. That will be different for different projects, for different companies, for different industries. It's all different. The opportunity cost of capital, depending upon the risk of that investment, the opportunity cost of capital varies. And you will learn in due course, probably in the next module or the module after that, you will learn, how to calculate the opportunity cost of capital. More realistic is how much does it cost? What is the opportunity cost of capital? How much does it cost you to raise $1 of capital? Your capital is a mix of your equity and debt, right? So how much does it cost you? That is the cost of your capital. So how much does it cost you to raise $1 of your capital, which is a mix of your debt and equity? That is the opportunity cost of your capital. You are investing X amount of dollars, for something. Let us say for your MBA, what is it worth outside? If you took the same money and invested outside, how much would you get? That is the opportunity cost of investing here. Same thing over here. When you're investing some money in your company, what would you have gotten if you took that money and invested it somewhere else? Same risk class. And that you will see is different for different kinds of firms, different industry groups. The opportunity cost of capital for, it depends upon the risk. So it is the expected rate of return foregone, given up by investing in a project. I mean, we can go more and more about it, but we will talk about it in detail in the coming modules. How to calculate it. That is the realistic discount rate. For that kind of firm, for that kind of investment that you're making. So that's why they say always use the opportunity cost of capital. So once again, coming to the basics of net present value, suppose we can invest $50 today and receive $60 later today. What is our increase in value? 60. You're investing minus 50 is going out plus 60. So your net is $10. So the added value is $10 over here, right? That is the concept here. Suppose we can invest $50 today and receive $60 in 1 year. What is our increase in value given 10% expected return? The opportunity cost of capital is 10%. R is 10%. Discount rate is 10%. You can use this in an interchangeable manner. So the cost is 10%. So you take the profit, you discount $60 at the end, you're getting 1 year. So $60 divided by 1.1 to the power 1. You discounted, this is the present value. And you add the 2 and you get a net profit of $4.55. So the added value is $4.55 because you're combining, the concept of time value of money, 1 plus R to the power T here. Okay. So that is that is the pictorial view of present value. And when we talk of valuing, for example, here, let's apply this to value an office building. Okay. In your book, they use that to this concept to value an office building. So they say that the cost of your office building just now is $350,000. And if you sell that building at the end of year 1, you get $400,000. Now, so what is the estimate opportunity cost of capital for equally risky investment in the capital market? So here, for this kind of investment in this building, 7% is the cost of capital for this kind of risk. Just now, we'll just give you the cost of capital, but eventually you will have to compute them, depending upon the business, the debt to equity mix of your business, and you will learn how to do that. Particularly when you're doing valuing equity, for equity, you'll also learn how to value an equity, a stock, for example, how to value that. So recall that a project's opportunity cost of capital is the foregone return from investment in the project. So 7% is the cost of capital. 350 you're investing today, 400 you're getting tomorrow, right? So then you discount the future cash flows of $400,000 by 1.07 to the power 1. So today's dollar, if you get 400,000 at the end of year 1, today it is worth $373,832. So the question is, in today's dollar, if you look at what you get tomorrow, you're getting $373,000, and today you invest $350K. So it's a positive NPV project. That means Your present value of future cash flow is 373,832 net of or minus today's investment of $350,000 is $23,852 positive NPV. Net present value is positive. So go ahead and invest, right? That is the decision. Go ahead and invest. It's a positive NPV. So the concept should be clear by now. Net present value is the present value of all the future cash flows minus your today's cash flow, which is your required investment. So C0 is today's cash flow, which is always a negative value, plus your positive cash flow that you're receiving in future. That is the net present value. The present, cash flow discounted at 1 plus r to the power t. And so you take the t can be 1 year, 2 years, 3 years, n years, whatever you want to call it. So your net present value is C0, today's investment, plus the present value of all the future cash flows. This is your net present value concept. Very, 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 very important concept in all walks of finance. Once again, C0 is your initial investment, C1 is cash flow in time 1, C2 is cash flow in time 2, CT is cash flow in time T, T is the time period of the investment, R is the opportunity cost of capital, or the discount rate, whatever you want to call it. Once again, to summarize the net present value rule, you will increase your shareholders' wealth by accepting all projects that are worth more than the cost. Therefore, they should accept all projects with a positive net present value. Recall that the project is discounted at the opportunity cost of capital. And for mutually exclusive projects that are not related to each other, choose a project with the highest net present value, provided at least one of those projects has a positive net present value. So always choose the higher NPV. And of course, it should be positive. Got it? So these are some basic rules of net present value. Another important issue over here is risk. Remember that high-risk projects require a higher rate of return because people want to be compensated for taking higher risk. So higher required rates of return or higher opportunity cost of capital or higher risk cause lower present values and lower net present values. They will lead to lower present values and lower net present values. Because you'll have higher opportunity cost of capital, right? So R will be high, your discount rate will be high. Discount rate will be high, then your cash flow will be discounted at a higher rate. So your present value will be low, net present value will be low. Remember that, okay? Higher opportunity cost or higher risk will cause lower present value and lower net present value, always. So for the earlier example of investing in office building, if you invest $350,000 initial investment, $400,000 cash flow you're getting at the end of year 1, and the 7% is the cost of capital, then you get $23,832 net present value. We saw this, we already calculated it. What if the R was 12%? Obviously, if the interest rate is 12% or the discount rate is higher, that will lower the present value. So here you will see my present value, if I use at 12%, I discount $400,000 at 1.12, obviously my cash flow now my net present value becomes 7,000. The present value of cash flows reduces to 357,000 instead of 373,000. So now I'm just getting $7,143 as net present value. Obviously, is 1/3 is my net present value. So that is the story here. And we just showed you, by numbers, what we said earlier, that higher the opportunity cost of capital, lower the present value and net present value. The next point about net present value. Again, I showed you the calculation here. 7,143 is the net present value. So new net present value 7,143, now less than 21,832 at 7% COC. So morals of the story, once again, higher the cost of capital, higher risk, lower the net present value. Lower the cost of capital, lower risk, higher the net present value. Remember this as a rule. Note that if a project has zero net present value at a given cost of capital, it will always generate a positive net present value for safer projects with lower cost of capital, or less than X%, whatever you are saying. Obviously, this makes sense, right? If it's a zero NPV at a certain level of R, then when you lower the R, what happens? NPV goes higher, it will become positive. This rule that we are talking about, the lower COC. So if you lower the cost of capital, your NPV will become positive. The name of the game is to beat the cost of capital. You will always win that way. So here is an example. You have the opportunity to purchase an office building. You have a tenant lined up who will give $25,000 every year in cash flows for 3 years. At the end of 3 years, you anticipate selling the building for $450,000 after 3 years. How much would you be willing to pay for this building now? Assume that 7% is the opportunity cost of capital for this project. So you have a choice here. You want to buy a building, the building is generating $25,000 per year cash flow for 3 years, and at the end of 3 years, you anticipate selling this building for $450,000. How much would you be willing to pay for the building just now? What is the present value of that investment? And the opportunity cost of capital for this kind of investment is 7%. Okay, so there we go. We put it in a picture form. So I'm getting $475,000 over here at the end of year 3. And each year, so 450 is the resale value plus $25,000 is the selling price. Is the rent. So rent plus selling price 450 is 475. Then year 2, I'm getting 25. Year 1, I'm getting 25. The question is how much I'm willing to pay now. Just discount them. Discount them to today's dollar at 7%. If you discount them to today's dollar and 7%, then you will find that it is worth $432,942 today. And if if you get a deal less than this, then you're good. Make sense? And you can do that in Excel. So if the building is being offered for sale at a price of $375, would you buy this building? Here, 432,942 is the present value of the cash flows. If the building is being offered for sale at a price of $375K, would you buy this building? What is the added value generated by your purchase and management of the building? That is, what is the net present value of the project, right? Common sense. You're paying $375 just now. You're discounting it discounting the cash flows by 7% to the power 1, 2, 3. The net present value is $57,942. There is no question. This is a positive NPV project, right? So the answer is clear. You go ahead with the purchase, and the net present value added is 57,942 for you. So this is one way of using it. Another example, what is the maximum you should invest in a project now, just now, time zero, if the cash inflows are estimated at $50,000 annually for 3 years? Every year you're getting 50K, and the cost of capital is 9%. So this is consistent. 50K annually you're getting for 3 years, and the cost of capital is 9%. Remember here that the investment, what is the maximum you should invest in this project? Okay, so you take the cash flows 50, 50, 50, you discount at 9% to the power 1, 2, 3, right? Plus the initial investment, that is your net present value. So your maximum investment will be what? NPV is 0, you put the initial investment equal to the cash flows, that is a 0 NPV. And for that, if you add these, you get $126,564. This is the 0 NPV. This will give you 0 net present value. If your initial investment is less than this amount, you are in the money. If it is more than this amount, it will be a negative NPV. Remember that. Okay. What is the net present value of a project that costs $100,000 and returns $50,000 annually for 3 years if the opportunity cost of capital is 14%? Once again, $100,000 negative plus 50, 50, 50 discounted at 14%, year 1, year 2, year 3, net present value is $16,081.60, positive net present value. Good for you. Positive is good, negative, not good. For mutually exclusive projects, are projects that they don't relate to each other. And project interactions are a different issue over here. When you need to choose between mutually exclusive projects, the decision is very clear. You calculate the net present value and choose the one with the higher NPV, provided, make sure that at least one of them is positive, should be positive, more than 0. So calculate net present value from those options, choose that have positive NPV and choose the one with the highest net present value. And you get the answer. So here is another example. Select one of the 2 following projects based on highest net present value. Okay, so you have 2, one cash flow is negative 800 just now, and then 350, 350, 350 is the cash flow over here in the future years. And the other one is you don't invest 800, you invest 700 just now, but you will get only 300 cash flow every year. What is the net present value? And the discount rate is 7% over here. So once again, what I'll do is just to reinforce what we were doing, I will show you how to do this in Excel. So I'm going to here, copy this. Copy this. And then go new share. Come back to the Excel sheet that I was sharing. Share. So here, there's another example. So I'm going to put it here. Here are my cash flows. Just want to make sure. Can you see this spreadsheet? Thank you. So here are the cash flows. How do we get to the net present value? Okay. So once again, I'm going to take this here, Control X and Control V. I'm going to put it here. Time, cash flow, time. I'm going to put, this is, instead of C0, I'll put 0, 1, 2, 3. Once again, I'll put 0, 1, 2, 3. This is the NPV that it is they are giving. So once again, I'll show you how to do this in Excel. The cash flow I have for the two projects. I'm putting A and project B. Okay. Now, for my interest rate over here, remember, my discount rate or the interest rate. How much was it? 7%. So 0.07. This was my discount rate. You know, you can format it in a percentage format, but up to you. You know, format the cell in percentage format. There you go. 7% is my rate. Okay. Now, first thing is, what is my discount factor for time 0, 1, 2, 3 at that interest rate? So I put my discount factor or discount factor for present value. I'm going to this here. Yeah. And put this here. The discount factor. So this equals 1 divided by 1 plus R. I'm fixing this cell $, to the power T, which is this. This is my discount factor. I copy this across for 3 years. There you go. Same thing I do here, equals my discount factor, Control C, Control V, equals, it will be the same, 1 divided by 1 plus R, fix this cell, $, to the power T, to the power T. There we go, 1. And I copy this across. It will be the same numbers, should be the same numbers. Yeah. Now, what is the present value? First, I calculate the present value of each cash flow. Present value of each cash flow. Each cash flow. Product of the two. This is the product of the two. So this times this. The same here. Let's go across. Same thing here. Equals product of the two. This times the cash flow here. There we go. Copy it across. So you want the net present value, just sum it all up and you'll get the net present value. What net of this minus this. So if my net present value over here, first I get the present value of total cash flows, which is just now present value of total cash flows. Right? And this is actually, if I take from time 0, this will become net. This is with the same amount. This is NPV, including including time zero, including time zero. So this will be equal to what? Equals sum of the above cash flows, right? Equals sum of the above cash flows here. This is net cash flow. $118, $118 is the same. And here it is what? Present value of total cash flows will be equal sum of these. $87 and $87. This is how to do it in Excel. Now, you can use the present value formula. You can use the net present value formula also. Net present value formula does the same thing. So, using the present value formula, so this is the net present value. This is the NPV. NPV. This is NPV. NPV. Same thing. This is not complicated. All time value of money, today's dollars, add them up. If you include today's, that means time period zero, the investment now into your cash flows, it becomes net present value. If you don't include that, it is, don't include that, then that is not your net present value. That is your present value of all the cash flows you can get. So if you go step by step, you will never go wrong. So if you want to use the present value formula using PV formula, again, remember, the PV formula spits out negative numbers. So here I have constant stream of cash flows, $350 for 3 years. And here in the second part, I have $300 for 3 years. So I can use my present value formula here because these are not different cash flows. It's an annuity. So present value formula, notice here, you want to know what each formula does, it will tell you here. So when I go on the formula and I go financial and I go present value, it will tell me what it does. So it's very easy to not get misled. So what is it? It tells you that it is the interest rate per period. For example, use 6%. So R is the interest rate. What is NPR? It is the total number of payments. It will tell you exactly. What does this formula do? It returns the present value of an investment, the total amount that a series of future payments is worth now. That's what it does. So I go equals present value, and I take the present value of the same cash flow. So what is the rate? My rate is 7%. I fix it at that. What is the NPER? It's 3 years. Number of periods is 3 years. And what is the payment I'm making? Pick any number here. It's 350, the same number, right? So this is the present value for year of cash flows for year 1, 2, and 3. There you go. It will spit out a negative number of here. You want to make it positive, you can make it positive like this. So this is positive cash flow. Now I want to make it net of the initial investment. So minus the initial investment. If your initial investment is already given in a negative number, then you add the investment. This is already a negative number, so I add the initial investment. This. So it is $118.51. Same thing. Using the present value formula. Got it? You can use the NPV formula. Using NPV formula. First of all, find out what it tells you. So you go to formulas, go to financial, and go to NPV and see what it tells you. Understand. Returns the net present value of an investment based on discount and series of future payments, negative values of payments, and the income, which is positive value. Okay. So here, if you use NPV formula, you have to use it like that. Okay. So NPV, if I do instead of present value, it will ask me for a range of values. So here the way it does, financial, net present value, and say, what are the values? Value 1, value 2, value 3, cash flows, right? So my rate over here is 7%. And my values over here is what? Return value 1, value 2, value 3 are 1 to 254 payments and income equally spaced in time and occurring at the end of each period, not beginning, end of each period. So these three values are my values over here. So notice, for those 3 years, my net present value is what? My net present value is $918. Then I want to deduct today's payment. So I want to, this is already a negative number. So I want to add it plus today's payment. Bingo. $118.51. Same answer you will get. So this is how you use the NPV formula and the PV formula. Don't get confused between them. Always look up. And the safest way is to use this mathematical thing. You will never go wrong here. Never go wrong here. If you want to check your answer. Got it? You get the discount rate, the present value factor, and multiply. Here, the discount factor, and then you multiply. You will never go wrong. So I'll stop sharing this part. I'll go to new share and come back to my slides now. Share. Can you see my slide? PowerPoint? Okay, thanks. So, some more concepts here, because sometimes for a company, the funds are limited. You can't, you have only so much budget. You can't spend more, right? A limit is set on the amount of funds available for your investment. You don't have unlimited fund. That is called capital rationing. Capital rationing simply means limit set on the amount of funds available for your investment. Without capital rationing, the net present value will always work, without any doubt it will work all the time. But if you have limited funds, then you might have to give up some high NPV projects because you don't have the right amount of initial investment. It happens to all of us when we start in the beginning. You can't start from the sky straight away. You have to go build it step by step by step. Why? Because you have capital rationing. Only so much just now, and then you invest that much. So in case of capital rationing, the net present value, you'll have to be careful there because you might have to bypass projects that have positive or higher net present values because of capital rationing. Capital rationing can come in different ways in companies. You can have internal capital rationing, which is a soft rationing, it's called, limit imposed by internal resources, your cash flows and all those kinds of internal resources. Those you can adjust somehow. But if you have to raise money, if you have soft rationing, for example, you don't have funds within the company, you can reach out to capital markets and you can get money from the capital markets, right? From the financial markets, you can borrow, right? But if you don't have money available from external resources also, that is a hard rationing. That is tough to fix. Limits on the available funds imposed by external resources, such as unavailability in the capital markets. So this is hard rationing. Hard rationing is tough to cross. Soft rationing you can jiggle through here and there through external resources. But if you don't have access to outside funds also, then you're gone. Then you might have to bypass. It doesn't mean it's the end of the road. But then still also you can make wiser decisions using the NPV, but you might have to forego best opportunities. Now, so far so good about the net present value, right? What about how would it be if we knew, for example, at what rate I get zero net present value? At what discount rate I can get zero net present value? As long as I can beat that rate, I'm good, right? If my rate of return is higher than a rate at which I get zero net present value, then I'll always beat the cost of capital. So remember that. That is the IRR. The internal rate of return is that discount rate where you'll get zero net present value. And I'll show you how to get that too. It's very easy. So people switch between the two. So internal rate of return is based on net present value, honestly. They're related. The rate of return at which you get zero net present value is the IRR. And as long as you can get a rate of return that beats your IRR, you are good. Because at that rate, you will get zero net present value. And the other is rate of return rule that everybody knows. Invest in any project as long as you can beat the cost of capital. Invest in any project offering a rate of return that is higher than the opportunity cost of capital. If you do that, you will always get a positive net present value. So your rate of return, it is your whatever return cash flow you're getting in the future minus your investment divided by your investment. That is your rate of return. And we'll go through lots of this. For an investment to be viable, rate of return should be greater than your IRR. You should beat the IRR. Then only you will have positive NPV, because IRR is zero NPV. And if your rate of return can also beat the cost of capital, if your IRR beats the cost of capital, then you're good. You got to beat the cost of capital. Now remember, here we are talking about investing money. You have money, you're investing money. You want to beat the rate of return. If you're borrowing money from somewhere else, somebody else is investing money in you. Your rules will reverse. So be careful when you apply these rules. When you're borrowing money from somebody else, somewhere else, others are investing in you. So your rules will be reversed. So for borrowing projects, if the IRR is less than the cost of capital for investing or lending project, it will always have a negative net present value. Once again, we'll summarize these as we move along. But let's go into IRR, internal rate of return. You can purchase a building for $350,000. At the end of the year, you will sell the building for $400,000 on same example. What is the rate of return on this investment? Of course, the rate of return is the difference between the two divided by the initial investment. So 400 minus 350, that's 50 divided by 350 is 14.29% is the rate of return. This is the rate of return that you're getting, right? Now, to see it in a picture form, at the IRR, 14.29%, we'll show you here. If you're getting 4.29% over here, this is the internal rate of return for a project. Net present value is zero over here. The discount rate, the rate of R is over here. Okay, let's apply this. You're getting this at the end of year one. If you discount $400,000, by the opportunity cost of capital by 14.29%, what will you get? You'll get zero NPV. Do you understand what I'm saying? So we'll see this as we go along. Say, let's do this. Let me show you, new share. Come to my. So we are on my spreadsheet again. You can see it. Once again, I have to ask. Can you see the spreadsheet? Okay, thank you. So what was the example? You invest now, time zero. Let me just change this was 14 point some percent. 14 point, if I remember correctly, it was 14.29%. So 0.1429. Okay, I'm just working on this part now. This. So my cash flow, my investment just now is $350,000. And at the end of year one, I'm getting $400,000. That's it. Notice over here, delete all this, right? Investment is negative. Yeah. I'm going to delete this. I deleted some things here. Let me go back. This is 0. This is 0. Right? 0. 0. Okay. So what is the present value of this cash flow? You can see $350,000. 3.29. You can add a few percentage points, whatever, 0.0 something, rounding of decimals. It is about $350,000. So if you compare the two, it is 0 net present value. So the net present value be equal to sum of these two cash flows over here. And this is, what is happening here? 349,998. Why? Oh, because this has to be negative, my friend. No. What is happening here? Yeah, negative. So negative. So it is 0.13 is because of rounding of decimal places, because this is 349,000. It will be 0. Add 1, whatever. Let's say equals, I want to find out here, equals IRR of this cash flow. Let me give the exact decimals here. Format cells to decimals. See, is 14.29, it is a rounded number. 14.2857. If you do all these things, and Control C, Control V. Oh, there's a number. Sorry about that. Control copy and put the number here. 1, 2, 3. There you go. There you go. So the net present value over here is 0. At 14.2857%, his net present value is 0. So that's what I was trying to show over here. This number is also incorrect. So because it is taking the previous figures into account, that's why the NPV formula is giving you the 0 NPV over here. So again, you have to be careful how you use, because this is keeping other things in mind. A lot of steady cash flows. This is not the same cash flow, right? It's just one cash flow you get. So that's not good. So there you go. So this is what I wanted you to see. A new share. Want to go back here. Share. Can you see my slides now? Thank you. So this is what I wanted to say. The rate of return, this will give you 0 net present value. Okay. This is the internal rate of return. And to show you how you get the internal rate of return, you have to use the IRR function, as I showed you here. So let's say a project costs $100,000 and provides annual cash flow of $30,000 for 6 years, starting 1 year from today. What is the IRR of this investment? So again, 30,000 for 6 years, you discount, at the IRR, and your initial investment is $100,000. So what is the IRR? It will be 19.91%. This is the rate of return that will give you 0 net present value. Once again, if I have to create $30,000 for 6 years and $100,000 now, if I have to do it in Excel, I want to share the Excel again with you, and I'm creating a new cash flow here. Okay, so $30,000, 30, 1, 2, 3. I do for 6 years. 1, 2, 3, 4, 5, 6 years. And $100,000 now. Just now, this is time once again. This is time. And this is cash flow. And this is $100,000 now. Minus 100. 1, 2, 3. Right? And this is 30 throughout. So I want to know at what rate I will go, my net present value will be equal to 0. And I know that that is the IRR. Okay? Internal rate of return. How do I get the internal rate of return? Very simple. Equal IRR. Once again, I'll show you through the financial functions. Here, financial, go to IRR. What does it tell you? It tells you what are the values of the cash flows you're getting. And it will immediately count the cash flows. 6 years plus 1 now, right? See, it is telling you straight away, your IRR is 19 point, if I just round it off, format cell decimal places, 1, 2, 3, 4, 5, 6, 7, 8, whatever. 19.9054147. At this rate, if you discount, then if this is your discount rate, you will always get 0 net present value. You can check it. You can do net present value function and do the present value. You'll see you'll get a 0 in NPV for this. So it's nice to know this. It's nice to know your rate of return that you expect from a project should always beat this. Then only you will have positive net present value. Or your cost of capital should be less than your IRR. Then you will beat the, because this is the discount rate, right? So if the discount rate is less than this, then if the cost of capital is less than your IRR, then your project is positive net present value, always. You'll beat. So just find out, and you get these cost of capital figures for each industry. You get those. Those are the hurdle rates. They are called hurdle rates for each industry. What is the cap rate? They will say, what is the cap rate for this kind of investment? Those are the hurdle rates. Based upon the kind of industry, the kind of firms, the kind of business you're running, they will have different kinds of, for biotech, it will be different. For pharma, for restaurants, it will be different. Even in restaurants, you have, quick service versus fast food versus QSRs versus the full service restaurants. It will be different rates. Hotels, different rates. Like that. Okay, so this is how you get IRR. Just use the IRR function and it will simply tell you how to get that. Coming back to IRR again. So we got 19 point something. Another example here. You can purchase a building for $375,000. Investment will generate $25,000 in cash flows. That is your rent, right? This is the real estate that we are talking about. During the first 3 years, at the end of 3 years, you will sell the building for $450,000. Same example that we did earlier. What is the IRR for this investment? Again, you do the same thing. You discount it, and you'll get the IRR is 12.56%. That means at 12.56%, it will be 0 NPV. And in financial calculators, you have the IRR button. It will tell you. So here, 12.56% is 0 net present value for this project. Notice over here that as you go along, as the R increases, you keep going negative, right? Cost of capital. So the cost of capital has to be less than this. Then only you will have positive NPV. Got it? So again, I just showed you how to do this. So you can apply the same thing over here. Same on a spreadsheet. So you have two proposals to choose between. The initial proposal H has a cash flow that is different than the revised proposal I using IRR. Which one would you prefer? Notice over here, classic example of being cautious with IRR. Okay, so here NPV is 12.56% in one proposal, and the other is cash flow. You get 400,000 just now. So the NPV is 14.29%. Okay. So which one to choose? Obviously, you go for higher NPV, right? Because you're getting 400,000 just now, after at the end of year 1, instead of getting at the end of year 3. So you go for a higher NPV, right? Notice over here, the two projects, if you take the net present values and you plot them, this is the original proposal, and this is the revised proposal. So the two are equal at this point, 11.72%. At 11.72%, if the IRR was 11.72%, then it would not matter. But over here, when you are seeing that IRR is, when the IRR is 14.29% versus, you have IRR of 12.56%, obviously the NPVs, look at the NPVs, how it varies. Your IRR of 12.56% is better, isn't it? Because it generates higher NPVs over here. So even if you have a higher IRR, bottom line is not getting confused over here. You got to beat the cost of capital. So two projects, one has an IRR of 12.56%. That means, if you have a rate of return of 12.56%, you'll get zero net present value. And here, rate of return of 14.29%, you'll get zero net present value. Why will I go for 14.29? I'll go for this. I'll get more money. Got it? So you have to be cautious when you're using the IRRs over here. This is the IRR. Even though IRR for 14.29% is high, it doesn't mean that this is better than this. NPV is another story. So remember, IRR has to beat the cost of capital. At zero net present value, you are equal to the cost of capital. So at 14.29%, you're equal to cost of capital. And here at 12.56%, you're equal to cost of capital, which is better. 12.56%, for easy, you after that, anything else, even 13.56%, you are positive NPV. So you'll go for this. So you have to be cautious when you choose the IRRs. Okay. We did the same thing over here. See the NPV, when you look at the NPV over here, IRRs. The 14.29% IRR is giving you only 23,000 and at 7%. 12.56% is giving you 57,000 NPV. It's much more, right? So there are some pitfalls of IRR that you have to be careful about. First is lending or borrowing. Again, your borrowing will be opposite of lending, as I told you. The rules will be opposite. This is contrary to normal relationship between present value and discount rate for borrowing. So for borrowing, the NPV of the project increases as the discount rate decreases. We went through it earlier. Then the second thing is when you have multiple rates of return, certain cash flows can generate zero NPV at two different discount rates, particularly when you have positive, negative cash flows like that, then the IRR doesn't work because you will have multiple IRRs. Then always resort to net present value. Net present value is the best. And then, of course, for mutually exclusive projects, IRR sometimes ignores the magnitude of the project also, eventually long-term and all those kinds of things. So you got to keep those things in mind. Net present value is the best amongst them. Okay. Of course, another thing is profitability index. That also depends upon the net present value. What is it? It is the net present value of $1 of initial investment. That's what the profitability index is. The net present value of $1 of initial investment. The net present value divided by your initial investment is your profitability index. So here, the ratio of net present value to initial investment. Example, if a project has a cost of 50,000, profitability index of 0.4, what is the net present value? Again, use this equation. Profitability index equals net present value divided by initial investment. So my net present value is profitability index times the initial investment. So I multiply them, and so my net present value for this project is $20,000 positive. 0.4 index, right, times 50,000, $20,000. We use this profitability index quite a bit, and it is very helpful sometimes. Here is an example. You have 3 projects, okay? First project, initial cash flow is $10,000 you're putting. And then you get cash flows C1, C2. You're getting, net present value. If you're at 10% when you calculate net present value, you'll get your net present value of 21.4%, right? So the net present value of 21.4%, $21.4, sorry, at 10%, divided by minus 10, which is, we take the absolute value of the investment. So divided by 10 is 2.1 is your profitability index. Okay. Now here there are 2 other projects with initial outlays of $5 each that give you different cash flows. Net present values are lower, obviously. It's $16 and $11. But the profitability index of this, is of project D is 16.07 divided by 5. So it is 3.2, very high. And for E, it is 2.4. The profitability index is higher for these 2. Notice when it comes handy. When you have capital rationing, you have limited funds available, right? Sometimes you may not have $10 available. It can be 10,000, can be 10, it can be 100,000, it can be, 10 million, whatever you want to call it. But sometimes you don't have that kind of fund available. So you can make, smaller investments with higher profitability index. So it works in case of capital rationing very, very nicely. Not only that, even if you have $10 available or 10 million available, you can invest in 2 projects of 5 and 5, D and E, and get better value. The net present value of the 2 you can add. The net present value will be 16 plus 11. That is basically, this is $28 and 1 cent. That is positive, 28 something. You add these 2. So which is better? Spending in D and E versus spending in C. Obviously, you use your 10 more wisely if you spend in D and E, because the profitability index is much higher and the net present value is maximized. So that is where profitability index comes handy. So very, very useful tool for us. Very, very useful tool for us. Okay. The final part over here, and in the interest of time, I think I will continue here so that we can complete this, is project analysis. Very, very handy tool for you, especially when you have, let's say these criteria, present value, future value, IRR, all those things. Then how do you evaluate different projects, different scenarios? Things can happen, right? So pessimistic, optimistic scenarios, normal scenarios, we have sensitivity analysis called. What happens if certain variables, critical variables, they change? What about interactive changes? Scenario analysis it becomes. And then you can extend the scenario analysis to simulations. With multiple iterations, it becomes simulations. So a very handy tool for decision making when you're evaluating projects over here. So especially capital budgeting project means large investments if you have. So in your company, we always ask people to submit their capital budgets for the year, right? What are the planned investments that you want to make over the year? And in the decision process, you submit your capital budget, you develop and rank all the investment projects for the company, and then you go through the project authorization stage where this can happen. This can happen because of so many reasons. Maybe there is a new legislation that requires you to present your, to do something, so you have to buy something, or some maintenance or cost reduction reasons, you're supposed to do an overhaul, or because you want to expand your capacity, you want to make an initial investment, right? So many reasons. You want to expand in the area of new products, so that can be a capital budgeting decision. So many reasons there can be. So how do we evaluate them? One way to do this is sensitivity, how to handle uncertainty. So one way to do this is through sensitivity analysis. What do we do here? We analyze the effects of projects' profitability because of changes in some variables, like your costs, your sales might change, your costs might change. Let us say there is a COVID kind of situation where the sales, especially in retail kind of a thing, it's all influenced. It's affected badly. Especially for the tourism industry, it's horrible just now. So the sales will go down. So those are pessimistic scenarios. And then normal scenarios. Then optimistic scenarios you can have. Each critical variable is changed one at a time. If the change does not affect outcome, the variable is not critical. Okay, so and then the scenario analysis is project analysis given a particular combination of assumptions. Lots of interactive changes are happening. So that is scenario analysis. And simulations are estimation of the probabilities of different possible outcomes. So you can have so many different outcomes, and you make decision trees. Break-even analysis you do. There's another kind of a thing over here. We break-even analysis where you do no profit, no loss kind of scenario, and you find out where you're breaking even. So lots of ways of doing this, and you should have an idea of these too. So here is an example of sensitivity analysis. This is the first thing, right? There are two scenarios over here, two kinds of projects over here. One is base project, and the other is, over 12 years you're taking. Year 0, just now you're investing $5,400,000, and years 1 to 12, on an average, this is what you're projecting, right? So my sales you're projecting at 16 million, variable cost 13 million, fixed cost 2 million, depreciation is 450,000. So my pre-tax profit you're projecting on an average, in your company at, your deduct all your costs from your sales, so $550,000, and if you're taxed at 40%, then $220,000 is your tax. So your profit after tax is $330,000. So your cash flow from operation is what? It is your net profit after tax. This 780 is net profit after tax plus your depreciation. This is the rule of accounting. Depreciation is an artificial expense. So you add that to the net profit after tax and you get the cash flow from your operations. So your cash flow from operations expected from years 1 to 12 is $780,000. So notice over here that your variable costs as a proportion of sales is what? Your variable cost is 13, and your sales is 16. So 13 divided by 16 is 81.25 cents to every dollar of sales, 81.25%. Got it? This is your variable cost. This is called variable cost ratio actually. And 1 minus the remaining balance is called the contribution margin ratio. It is what part of that revenue dollar is left to cover your fixed cost and generate profits. And an efficient management generates higher contribution margin ratios. Higher the contribution margin ratio, the better it is for the company. So this is the key thing over here. Variable cost ratio, these are some assumptions you're making. The discount rate is an assumption that you're making that, yes, this is my discount rate at 8% on an average. And then if you discount it at 8%, and this is an annuity, by the way, because every year you're getting a cash flow of $780,000 net. So if you discount $780,000 at 8%, this is an annuity discount. So your net present value you're getting at $478,141. This is the net present value. So this is your budget. Okay, this is what you're doing. So given the expected cash flow forecasts listed on the next slide, determine the net present value of the project given changes in cash flow components using 8% cost of capital. Assume that all the variables remain constant except that the one that you are changing. See, you are just changing one critical variable over here, the cost of capital. So here, the same thing, your net present value you are calculating, your investment is 5.4, right? 5.4 million. And your net cash flow, then what is your net cash flow? So remember, you're going back to the old one, 5.4 million is your initial investment, right? And how did you get your depreciation, by the way? This is a straight line depreciation. So for people who wonder, 5.4 million divided by 12, you'll get 450,000. This is your depreciation, straight line depreciation. Depending upon whatever you're using, you use straight line ACRS. Here, straight line is used. So now assume that all the variables remain constant and the cost of capital is 8%. So if you discount that, what do you get? So my net present value, $780,000 cash flow I'm getting. Present value of that cash flow is, I discount it at 8%. My net of 5.4 million is $478 positive. This is 478,000, obviously, because 3 zeros are missing from here. These are all in thousand. So 478,000 is my net present value. It's a positive and net present value thing. You can keep varying this one factor, and that will give you your sensitivity analysis. So what are the possible outcomes over here? You can give, pessimistic, expected, and optimistic. This is the expected is average, pessimistic is bad scenario, and optimistic is positive scenarios. Okay, so pessimistic over here is worst case scenario. I'm investing 6.2 million. Optimistic best case scenario, I get a good deal. I'm investing 5 million. Average in the middle, I'm investing 5.4 million. Again, these are some assumptions you're making, subjective things. Sales, best case scenario, 18 million is the sales. Worst case scenario, 14 million is the sales. Average 16 million is the sales. Variable cost ratio, your average just now is 81.25%, right? Optimistic, you are a better controller than 80%. Pessimistic, 83% variable cost ratio. These are some assumptions. Fixed costs. My optimistic is just now it is $2 million, my fixed cost. But optimistic scenario can be 1.9. I negotiate it over a long run. And then the pessimistic is it can be even higher. So you have 3 different scenarios working for you, right? Keep that in mind. So then what do? We run a sensitivity analysis over here, NPV calculations for pessimistic investment scenario. Like that you do for optimistic and for average also. I'm just showing you pessimistic scenario. You use the NPV over here, same pessimistic figures you take, the net present value is a negative 121,000. I take the pessimistic figures. Like that, I take the optimistic figures, I take the average figures for all possible scenarios. If I summarize all those things, then for the pessimistic and average and optimistic scenarios, my net present values, notice negative, negative, negative I'm getting over here for my pessimistic scenario, and optimistic is going higher. Okay. So net present value always increases over here. My assumptions, my sales and everything, how things are changing. Same thing over here at 8% when I take the net present value. Notice over here, the calculations are there. Optimistic, pessimistic, like that, the calculations are there. So it's a nice thing to have sensitivity analysis, to have different possible options over here. Then what does scenario analysis do? Scenario analysis will combine assumptions using multiple interrelated variables. So over here, in this example, I'm investing 5.4 million just now. Then the base case is over here. And then you can take competing store scenario, another competing store scenario over here, for years 1 to 12. And of course, the assumption over here, there are two major assumptions you're making. One is that the competing store, because you're opening a new, somebody opened a new store right across you. Okay. So what does that do? Look what has happened in the scenario. More competition is coming, right? So more competition is coming, my sales is going to dip. My comp set will take some of my sales. My variable cost ratio, everything will change. So we make assumptions for those. There's a competition and no competition. Base case is no competition and column D is competition. Notice some assumptions over here. Competing store causes 15% decline in my sales. So if there is a competing store here, my sales declines from 16 million to 13.6 million. And my variable cost also increased to 82%. So from 81.25%, it goes to 82%. Obviously, if my sales goes down, my variable cost ratio will be affected, right? Fixed cost is the same, everything else is the same. There you go. So this is a scenario analysis. What happens if the market changes? What happens if, we have different columns over here? And I compare the two. So let us say, over here, one assumption changes. My decline in sales and my variable cost ratio is the second assumption. I can keep changing these two variables. I can build these variables into my formula. This will be the first one. For example, my sales will be whatever it is. The next sale will be is 15% decline. So this will be this one minus 15%. So that 15% is there. So if I change this 15% cell, to say 10% decline, then it will change automatically. If I change my increase in variable cost from 82% to 83%, things will change automatically. Everything will change. The bottom line figures will change. So this is called a scenario analysis that we are doing. The next thing is break-even analysis. Now in break-even analysis, what we do is we first learn at what point in sales we break even. That means there's no profit, no loss. Now there are two kinds of break even. The typical accounting break even will give you a certain figure, but it doesn't, now that you know the time value of money, it won't make sense in terms of time value of money. So you have to go to an NPV break even value. Okay. So here a firm has fixed costs. The firm has fixed costs at 1.2 million. Remember here, before we go ahead, we learned two things over here. Okay. One is the contribution margin ratio, the other is the variable cost ratio. So over here, my variable cost ratio in this example, my variable cost ratio is 82% in this competition scenario, 82%. That means from every dollar of sale I make, 82 cents are used to cover my variable costs. So what is my contribution margin ratio? My contribution margin ratio is 18 cents to every dollar. That means 18 cents what I have is there to generate my profits and cover my fixed costs. That is what matters in break-even analysis. So keep your eye on your contribution margin ratio. And that will tell you your break-even. Keep an eye on that always. Of course, this contribution margin ratio, this language is not used in your book, but I'm just explaining it to you that way so that you know the key between a good manager and a bad manager is the contribution margin ratio. For a poor management, the variable cost ratio will be high, that variable cost to sales ratio will be high. So your contribution margin ratio will be low, which is 1 minus variable cost ratio will be low. And for a better management, the variable cost ratio will be low, your cost controls are good, so your contribution margin ratio will be high. And the contribution margin ratio is the key to finding your break even. And you will see that just now. A firm has fixed cost of 1.2 million and depreciation is 1 million. At a sales level of 3.6 million, the variable cost of 2.304 million. What is the accounting break-even level of sales? So to find the break-even level of sales, the earnings before income taxes should be equal to 0, okay, in break-even. So that means all your costs and profits are equal. There is no profit, no loss. Profit is 0. The variable cost ratio here is what? 2.3 million divided by 3.6 million, which is your sales, which is 0.64. That means from every dollar of sales, 64 cents is variable cost. So what is my contribution margin ratio? That part of sales that contributes towards fixed costs and profits, that is 1 minus 0.64, that is 0.36. That means from every dollar of sales, I have 36 cents left to generate my profits and cover my fixed costs. So my break-even, accounting break-even sales will be my fixed cost with depreciation, which is your fixed cost plus your depreciation. So my fixed cost is 1.2 million plus my depreciation is 1 million. Remember over here, depreciation is an artificial expense. So fixed cost plus depreciation, and depreciation is also fixed. It's one of the fixed costs. So fixed cost with depreciation divided by my CMR, I call it contribution margin ratio. This language will not be there in your book, but this is a very useful tool. It will explain in a phrase what you have to divide it by, but this is your contribution margin ratio. So it's 1.2 million plus 1 divided by 0.36, that is 6.11 million is an accounting break-even sales. At this level, there will be no profit, no loss. So you know that you have to beat this. But notice over here that it depends how long you're getting you're generating your profits for. If this is, this covers a period of 12 years or so, then the time value of money, even in 1 year, the time value of money, what you invest just now versus what you get at the end of the year is two different things. So keep that in mind. So in the graphic form, the accounting break-even is represented like this. You have your dollars over here on the y-axis, the sales on the x-axis, and then the fixed costs are this horizontal line. My total cost is a dotted line because it's variable plus fixed, and my total revenue is this line. So where they are intersecting, that is my break-even point. Note over here that lesser cost control means more variable cost to sales ratio. And if there is a more variable cost to sales ratio, what happens? Your total cost line goes up. If it goes up, your break-even point goes up. Remember that, higher break-even points. So it all depends upon your variable cost ratio and your contribution margin ratio. Now, The NPV break-even analysis, I told you, it covers the time value of money. So it covers the risk associated with the cost of capital employed, the point where net present value switches from negative to positive. And here the same example to net break-even analysis, net NPV break-even analysis, given the forecasted data on the next slide, determine net present value break-even sales if the company's cost of capital is 12%. So here we go. My investment is 5.4 million and my variable cost ratio is 81.25%. Okay. And obviously my contribution margin is 1 minus that. Okay. So if I do all the math over here and I come to the net cash flow, that means my net profit plus depreciation, at break even, my net cash flow 5.4 should equal this, right? Should equal 0.1125 times sales minus 1.02 if you derive all this. Okay. The next point over here is the accounting break-even sales, therefore, is fixed cost plus depreciation divided by CMR, which we already calculated is 2.545 plus CMR is 18.75%, 13.067 million is the break-even sales accounting. The net present value break-even sales at 12%. If we take 12% as the discount rate, or the cost of capital, where the initial investment equals your present value of cash flows, if you take all that, then the net present value equals 0 when the initial investment and your present value of cash flows are equal, right? So if you do that calculation, my present value of cash flows over here, my initial investment is 0.54. Plus, I take an annuity factor over here times annuity factor for 12%, right? Times 0.1125 times the sales. What is 0.1125? 0.1125. This is, if you go back here to the previous slide, this is how I got. My net cash flow is 0.1125 times sales minus 1.02. Okay. So these two are equal at NPV break even. Present value of this, using the annuity factor at 12%. So if I solve for this, I get the net present value break even sales at 12% of 15.4 million, which is higher than this. So at accounting break even, you will always get negative net present value. So don't get misled by accounting break even. Although it is there, it is good. Many books and many accountants, they go for accounting break even. But you as finance experts should look more into it and look at the real net present value break even sales. So it will always be higher, little bit higher. The present value of annuity at 8% for 12 years. This is for 12 years, over 12 years. And that is 7.5636. So if you take the accounting break even and the NPV break even, the picture will be a bit different because here your initial investment also comes in and your cost of capital comes in. So it will be slightly higher. Okay. Another final concept is operating leverage, which is the degree to which your costs are fixed. So businesses that have higher operating leverage, they are very prone to revenue shocks. And if the revenue shocks, then they are really affected badly, or it depends. How? It depends upon the degree of operating leverage of that firm. Two firms with different levels of fixed costs, you can work harder and you can work smarter. You can get the same amount if everything is okay, and the firm with higher financial leverage, will have more debt and more fixed costs, can meet the debt service payments nicely and the sales are projected nicely. The higher degree of operating leverage, which is the percentage change in profits for every percentage change in sales, the higher DOL firms will tend to gain. So everything else, ceteris paribus, all else equal. Two firms, one has a higher DOL than the other, and the firm is performing all right. Then in economic booms, if they both of them have 1% increase in sales, the percentage increase in profits will be more for the higher DOL firm. The opposite will also hold true. For losses, the losses will also go fast. So it's a gamble. Okay. Degree of operating leverage is very important to understand. So here a company has a sales outcome that ranges from 16 million to 19 million depending upon the economy. The same conditions can produce profits in the range from 550,000 to 1.112 million. What is the degree of operating leverage? The percentage change in profits divided by percentage change in sales. Percentage change in sales is 18.75%. Percentage change in profit is 102.2% over here. So the 1 divided by 2 is 5.45 is the DOL. Okay. And firms use this, a lot. You can make good decisions based on, and the other thing is asset light, how asset light you are. This is a buzzword. Many companies, they don't want to engage in fixed costs. So they don't own real estates. Or franchising, less investment in fixed assets. Those are asset light companies. So asset light is one example where the DOL will be very high for those people. There are lots of strategic advantages of knowing DOL. So keep that in mind. Alternative estimation. Now, suppose that the company adopts a high fixed cost policy. Fixed costs are 22 million and the depreciation is 0.45 million. Assuming the profits of 550, what is the DOL? The DOL over here, you calculate the same way. They use the same thing, percentage change in profits or percentage change of sales can be, you can rewrite the DOL formula like this, and then you get 5.45, the same thing. Okay. And finally, the last thing is the real options, where you have to remember that the environment is very dynamic. If it is very dynamic, then you have the options, things keep changing. You have the option to expand, you have the option to abandon a project, then the timing of the option, when to use, when to do what. All those things you have to keep in mind. Flexibility, that also you have to keep in mind. If you have all those things, then you make decision trees. Decision trees are used. And where you diagram of sequential decisions, what happens when there are possible outcomes. So it helps companies to determine options by showing the various choices and outcomes. And the option to avoid a loss or produce extra profit has value. And the ability to create an option thus has value that can be bought or sold. So here you can have an example of a tree. See, this is, given one scenario over here. One is to make a investment over here, and the other is not to, one is 0 NPV. And this is the positive over here. So you invest $200,000 over here. And once you invest $2,000, what can happen? There can be success or no success, success or failure. If there is success, then you pursue the project, and we get a positive 2 million. If there is no success, then there is a failure. Then that is 0 NPV over here. Stop the project over here. So keep making decision trees based on changes over here, And once again, probability of occurrence is also very important. So if you have in your decision trees, when you make your decision trees, last one here, last slide here. So when you make your decision tree, I just wanted to share with you here. Oh, it has stopped here. Screen sharing has stopped. I apologize. Where did I lose you? Did you see the tree?
Yes, we did.
Okay. So if I share with you one small thing over here, one small thing, new share, whiteboard over here. This decision trees, I'll erase this off. Decision trees are always based out of probability of outcome. All right. So when we say probability of outcome, let us say here, we have, probability of options. So let us say that from an investment that you make, you have 30% chance, probability, 30% chance of getting, I'm not putting the numbers, or just put a number, say getting $100, and 70% chance of getting, say, say $80. So basic statistics here. What is the, how much cash flow are you expecting over here? What is the expected cash flow from this? Expected cash flow is, according to statistics, this will be 0.30 times $100 plus 0.7 times, 0.7 times $80. So that equals to how much? $30 plus 7 8s are 56, right? 56, right? Are we together here? My tables, how are they doing? Yeah, 7 8s are 56. So I go back to my share. So that equals how much? My expected cash flow is $86. So remember, this is basic statistics, okay? So then I use these probabilities and create trees, different scenarios. I create trees and make decisions and then keep adding at the end. So this is very highly used in operational research and those kinds of things people do. So very highly used over there. So I will stop sharing at this point, and I will also stop my recording, I think, at this point. Give me a second.